Now, let's talk about ratios that we can calculate in respect of any decisions that we make. We need to calculate return on capital employed. It can be called return on capital employed. It can be called accounting rate of return. Now, we have a company that has profit before interest and taxation, profit before taxation, profit after tax, and we know equity and non-current liabilities. When we are talking about return on capital employed, we are talking about all capital employed, so not only equity, but also long-term debt. So this means that we're going to divide by the sum of equity and non-current liabilities. When we are talking about the return that we need to divide, that would be a return that is going to be split between equity holders and debt holders. So this has to be profit before interest. So it would be 4,500 profit before interest and tax. If, however, we were supposed to calculate return on equity, then we would divide only by equity, so only by 15,000, and we would divide something that is distributed to equity holders. It's not profit before interest and tax. It's not profit before tax. That would be profit after tax. That is because only profit after tax is going to get distributed. Only that is used to pay out dividends. So profit after tax is 2,800. Now let's calculate the values of that. So return on capital employed, we would have 4,500 divided by 20,000. It would be 22.5%. Return on equity would be, we would take 2,800 divided by 15,000. That is 18.7%. Now, in this case, we have return on equity that is lower than return on capital employed. It is not always like that, actually. It would depend on how much liabilities you have, what is the level of taxation, what is the level of interest. So sometimes return on equity can be higher, sometimes return on equity can be lower, like in this case.